right, so welcome to Chapter 2, everyone. This is the Chapter 2 video talking about some of the practice problems that are posted on Canvas. If you've not watched the PowerPoint lecture video already, you absolutely should do that because this video jumps right into problems and doesn't do any of the lecture on the background information that's in a separate video. All right, so let's get right. All right, I left this in here as well. There is also a video that has a couple of practice problems, one from Chapter 1 and one from Chapter 2, so pay attention for that. These are your tax return due dates by entity, okay? You will have to know these. These should be memorized. These are pretty consistent across the years as far as individuals. Your tax return is always due the 15th day of the 4th month following the end of the tax year. Now, during COVID, they did move that due date. You do not have to know that, but these are the general standards, so you do have to memorize those. All right, so now we get to our first question, okay? And we've got Fred, our taxpayer, and he's got a high level of itemized deductions for 2 years relative to his income level. So what that means is he's got, I don't know, maybe he's got $25,000 of taxable income, and he has $15,000 of charitable contributions shown as a deduction, okay? He recently received an IRS notice requesting documentation for his itemized deductions. What audit procedure likely identified his tax return for audit? Well, so again, I'm just going to go through the answers and talk about why those are the answers. If you're looking for background information on all of this, go to the lecture video. So the audit procedure that would identify his tax return is called the discriminant function system. It's abbreviated DIF. Okay? And essentially, what that system does, the IRS has a tremendous amount of taxpayer data, right? And so they look at all of the taxpayers from a similar situation. So I'm a family of 5. So for my tax return, when they look at my tax return, they compare it to every other family of 5 that has a similar amount of taxable income declared. And then they look at our deductions. So they'll look at my property tax deduction, my mortgage interest deduction, and they'll see if that is within a reasonable range of the rest of that population. If it's not, then they assume that I am understating my income. I'm not declaring a bunch of income. And because if I can support, say I make $50,000 a year, but my mortgage interest deduction is is relative to $1 million mortgage, for example, they would look at my income level and go, how in the world are you affording that type of interest expense? And so that might put me in an audit bucket because my deductions would not be in line with my income amount. So that is how that discriminant function system works. Now we have Barney. Barney's tax return was audited because he calculated his tax liability incorrectly. So he made a simple arithmetic error. What IRS procedure identified his tax return for audit? So this is called the document perfection program. All right. And essentially what that means is, and it's gotten a lot easier now that things are electronic, the IRS sanity checks your math. Is your decimal point in the right place? Did you add 50 and 50 and get 100? Did you transpose the numbers in your Social Security number? Those types of things. So that is document perfection. It's just designed to choose or to identify arithmetic errors and clerical errors, essentially. All right, so the next question is regarding Wilma. And Wilma's tax return was audited because she failed to report interest earned on her tax return. What IRS selection method identified her return? So this is a fun one, right? Because the IRS has gotten really smart. And again, since things are electronic, it's gotten a lot easier. So the IRS uses what's called information matching. And essentially what they do is, so every bank is required to submit information to the IRS, all right? And so if you earn interest from a bank and don't declare it on your tax return, well, the IRS already has the interest information from that bank. So they match up your Social Security number on your tax return with your Social Security number on that interest information from the bank, and they can see if you've declared it on your tax return or not. So this is a pretty common one, and what you end up getting is you end up getting most of the time a correspondence audit. So they send you a letter and say, hey, we noticed that you failed to declare this $25.67 of interest from whatever bank. Based on that, you owe us an extra $3 of taxes. Please submit your check, by this due date. So that is how that happens. It's gotten very, very simple for the IRS. They do it for income tax, for payroll tax, so I'm an employee of UMSL. UMSL has to submit all kinds of payroll tax information to the federal government. My Social Security number is attached to all my payroll tax information. If I don't declare my UMSL salary on my tax return, it gets flagged via this information matching very, very quickly. All right, and so now we have kind of a different subject in Chapter 2. So you've probably already noticed that the Chapter 2 is not particularly calculation-based. It's much more conceptual, okay? And so this is one of those areas that we need to talk about a little bit. And again, there's more background on this in the lecture video. So we've got Pebbles, and Pebbles won a tax case litigated in the 7th Circuit. So hopefully you've already watched that lecture video, and you'll know that when you have a tax dispute with the IRS, you have the opportunity to go to tax court to get that adjudicated. And there are different circuits, right? And different districts across the U.S. The U.S. is divided into 13, right? Much like the Hunger Games. And so she just heard that the Supreme Court denied a writ of certiorari. Should she be happy or not? Okay, so the first thing you need to know is, what is a writ of certiorari? So essentially, a writ of certiorari means, so if it is denied, let me erase that. All right. Denied means that the Supreme Court will not hear your case. So tax cases are brought in front of the Supreme Court. Obviously, the Supreme Court is very, very busy. There are lots of important cases that are waiting to be heard by the Supreme Court. So in order for a tax case to make it on the Supreme Court's docket, it has to be a tax case that is a new issue, and it has to be an issue that has the potential to impact a very large number of taxpayers. Okay, so if the Supreme Court had issued a writ of certiorari, that would mean that they were going to hear that case. okay, that the IRS was successful and they were going to get, and the IRS was going to get to have the Supreme Court decide that case. All right. In Pebbles' situation, she just won. All right. So she just won at the circuit level. So at the appeals level, she has won. So that is good for her that she has won at the appeals level, and she wants to go home and not have to deal with this situation anymore. And she just heard that the Supreme Court denied the writ of certiorari. That means the Supreme Court is not interested in hearing that case. So Pebbles has won on appeal. The Supreme Court is not going to hear that case. So that means she's done. The IRS can no longer come after her for that issue. So, Pebbles is very happy. All right. If the Supreme Court had issued a writ of certiorari, it doesn't mean the Supreme Court agrees with her or the IRS. It just means the Supreme Court thinks it's a big enough case that they will hear it. All right. So then she'd have to go through another court case. All right. So now we have Betty, and Betty could not reach an agreement with the IRS. And so she's been to an appeals conference and she's received her 90-day letter, and she wants to litigate the issue, but she doesn't have enough cash to pay for the proposed deficiency. So what's her best court choice? Well, the cool thing about tax court is that you can request to go to tax court and you do not have to pay that deficiency first. You can go to tax court, and then if you win, you don't have to pay the deficiency at all. If you lose, then once that decision is made, then you have to pay your deficiency. If you go to district court, you have to pay your tax deficiency, and then you sue in district court for a refund. Okay? So tax court can be really beneficial because you don't have to have paid your tax liability up front. So for taxpayers who are having some liquidity issues, or if it's a very large tax amount, tax court can be very, very useful. All right, so now we have Dash Riprock. Dash Riprock is a full-time student, and he earned $2,500 this year from a summer job. He has no other income. He'll have zero federal income tax liability. His employer withheld $300 of federal income tax from his summer pay. Is Dash Riprock required to file a tax return? And then, should he? All right. So the answer is no. Dash is not required to file. All right. And the reason he's not required to file is because his gross income is below the filing level. And remember that filing level chart was at the beginning of this video, and it's in your PowerPoints, okay, and it's in your chapter. So if you make below that amount, and $2,500 is definitely below $12,000, you are not required to file. Now, the next question, should Dash file a tax return? Yes, he should file. And why should Dash file? Well, because his employer withheld $300 of federal income tax, and based on Dash's income level, all of that income tax that was withheld would be returned to him in the form of a refund. So he should file so that he can get a refund. All right, so now we're talking about estate taxes. All right, and so again, you can look at the charts and know the limits for these things. You just have to remember that the limits for these things are in the charts. So you're not expected to memorize this. You're expected to know how to go and get this, the answer to this from your schedules. So the estate of Barney Rubble earned $450 of income this year. Is the estate required to file an income tax return? And the answer is no. Estates do not have to file if their income is, sorry about that, I need to pay attention to my grammar, is below $600. Okay, so that estate only earned $450. They do not have to file a return. And so here is our last Chapter 2 practice problem for this video. And we've got Slate Corporation. That's very important. That's the entity type. Had zero earnings this fiscal year. In fact, it lost money. So it had what's called an NOL, which is a net operating loss. Must the corporation file a tax return? And the answer is a big old resounding yes. Corporations. And again, when we say corporations, we're talking about C corporations. In Chapter 15, we'll learn a whole lot of differences between C corporations and S corporations and limited liability corporations. If you just see this word corporation used very generically, we are talking about C corporations. Okay, so those are stock issuing corporations that could be public. C corporations are always required to file every year, whether they make $1, $1 million, $100 million, or whether they have a huge net operating loss. Either way, they always have to file a tax return. All right, so I hope these are helpful. As always, if you have questions, please let me know, shoot me an email, talk to me in class. If you're wanting the associated documents for this, look for them on Canvas. If they're not attached to a module, they're in the Files tab, so you can always find course documents in the Files tab. All right, hope this helps y'all. Bye.